Disney reported earnings before the market opened on Wednesday, and results were a little bit all over the map. There wasn't a ton of growth. There wasn't any big surprises in something like streaming, but the company is expecting to be more profitable than they originally thought in fiscal 2024. So that was the good news. Now, the stock market reaction wasn't all that positive. Shares were down about 4.4% during trading on Wednesday, but I want to go through the results and show where I think there's some positive signs and then where there's a little bit of weakness. This is really, I think, a long-term play because we're only seeing the beginning of the shakeout, particularly in streaming. We know that the entertainment business, the parks, the cruise lines, all those kinds of things are just going to continue churning out cash year after year. But we've only now in the last couple of months see the movie business turn around. We haven't really seen that flow through to streaming yet. Bundling is only in its early infancy phase, so they're seeing that churn is improving a little bit. And sports, ESPN in particular, is not yet going over the top. That will happen in 2025. So the groundwork is being laid for future growth for Disney, but we're not quite there yet. So that's the context with which I want to look through these earnings results. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's look at the high-level results. This is a look at results overall. Right here is the quarterly numbers, fiscal third quarter of 2024, calendar second quarter. Revenue was up 4%, so not a big increase in revenue, but income, operating income was up, earnings per share were up, cash flow was actually down a little bit. So the company had some restructuring costs. Streaming was not making money a year ago. Some of those things are turning around, but I think it's important to look at some of the detailed numbers. These are the three segments that Disney now reports. Entertainment, which includes the linear networks, and then also streaming. Movies are included in there. That was up 4%. Sports up 5%. That's ESPN primarily, so that's associated with the decline in cable. And experiences up just 2%, so not a real big surprise that it was a little bit weak on the experiences side. Costs on both sports and experiences led to a decline in operating income in both of those segments. Entertainment was the one big improvement. So I'll get to some of those details in just a second. Before I get to some of those breakouts, I do want to highlight Disney Plus up just slightly, and they announced a new price increase this week. So that will go into effect later this year. Looks like they're really trying to goose the profitability of Disney Plus, the Disney Plus Core, as they call it. So that takes out particularly Disney Hotstar. That was 118.3 million subscribers. So a really nice number of subscribers, but just up over 1%. Hulu up 2%, 51.1 million subscribers. And then you can see that they did give a little bit on price. I talked about this in my preview to the earnings. That don't be surprised if the bundling that they're doing, not only their own bundles, but also the bundles that are being distributed through other companies, if that means that prices are going to go down a little bit. But obviously with the new price increase, that's going to increase in the future, should help margins. This is a look at the entertainment results from their presentation. You can see that linear networks, so this is going to be ABC, ESPN, all the cable channels that go into that, are on the decline. No real surprise there. That continues to be a negative business for Disney, but it is still relatively profitable, $1 billion in operating income. Direct to consumer is the one. There is revenue growth, so this is streaming in particular, but not very profitable. So there's the balance there. Your profitable business is declining, your unprofitable business is growing. Content sales and licensing, not a real big business and not particularly profitable either. And that is primarily related to movies, so that should have a pretty good year this year. But again, the box office, even when the box office numbers are really big, not a lot of that money actually flows through directly to Disney immediately. More money is made kind of on the back end. So with things like streaming, licensing, in the past it was DVD sales. Those were really your money makers. Here's the subscriber trends. You can see that this is why the revenue numbers are up year over year. Pretty nice growth on that year over year basis, but on a sequential basis, not so much. Now, Disney did talk about later this year, they are going to put in some of the password sharing crackdowns that Netflix put into place. Said that in their tests, there wasn't a lot of pushback to that. So it seems to be something that customers are expecting. So that could possibly increase these subscriber numbers just like it did at Netflix. So something to keep an eye on. Again, the sports business continues to be driven primarily by ESPN domestic, $3.9 billion in revenue there and $1.1 billion in operating income. But again, that's not really going to be a growth business until it starts getting incorporated into the streaming bundle. We're supposed to have a tile for ESPN later this year, and then next year is when you would have a real over-the-top, fully digital experience for ESPN. The experiences business has long been the real moneymaker for Disney, especially as they've made this shift to streaming. So you can see that there was slight increases in domestic parks, slight increase in international parks as well. But the profitability was down. That was because of higher costs that go into running those parks, particularly labor. Now, one of the things they highlighted a lot, and they focused on more the animated movies in this presentation, but same goes for Marvel and the success that they've had over the past few weeks. But the movie business doing better is going to start a flywheel effect in the entire business overall. So more people are going to be subscribing to Disney Plus. More people are going to be going to the parks if the movies are doing well. Inside Out 2, highest grossing animated film ever with $1.5 billion. And Moana 2 comes out later this year. That's expected to be another hit. Wouldn't be surprised if we get close to those Inside Out 2 numbers. And then there's a lot in the pipeline. Toy Story 5 coming in 2026, Avengers 2026 and 2027. More Star Wars movies. Avatar has 3 films coming. So the content business seems to be churning much better than it was a couple of years ago. And that is also translating to more investment on the physical side. So cruise ships are a big area that is going to have the most immediate impact. Wish was launched a couple of years ago. Disney Treasure is going to launch later this year. And then they've got 2 more coming in 2025. So all in all, that flywheel is kind of set into effect for Disney, but we're not seeing the real fruit from that quite yet. And that will come as the ESPN goes over the top, as you have more of an impact from the success of these films in studios, and as more capacity is added to the experience business. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. So this wasn't an incredible quarter. It wasn't a bad quarter. Management did reiterate that they saw about $8 billion in free cash flow expected for this fiscal year. I also think the valuation is looking pretty attractive right now. You can see that the price to sales multiple is basically at its low point over the last few years. On a forward basis, that forward price to earnings multiple is about 16.8. On a trailing basis, it's a little over 30. But remember, we're at a depressed point in earnings. We haven't seen a lot of impact on the earnings side from the streaming business. So that's where we should really start to see a lot of operating leverage as the streaming business grows. That should make the valuation of the stock look much more attractive long term. But I think what we should look at Disney at right now is really setting up for growth in the future. So growth in the experiences business, continued growth in direct-to-consumer or the streaming business. I think that has a ton of runway, especially as sports goes over the top. And the scale that Disney is building in sports and in those content bundles for streaming, I think is going to be really valuable, give them a leading position in streaming as some of these other companies just continue to burn through cash. So that's the way that I'm looking at Disney's earnings report. I think it's a lot better than the market did. Definitely a stock I'd look to add to on any weakness over the next couple of months. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.